In the United States, the foundational pillar of the American dream is homeownership. The accepted doctrine is simple. Renting is throwing money away. Buying a house is an investment that builds wealth. This is a structural misunderstanding of accounting principles. When you evaluate a primary residence through the lens of raw mathematics, a house is not an asset. It is a heavily taxed, depreciating liability that transfers wealth from the homeowner to the financial system. To understand why, we must separate emotional attachment from financial reality. In accounting, there is a strict mathematical definition for an asset and a liability. An asset puts money into your pocket. It generates cash flow, or it appreciates independently of your labor. A liability takes money out of your pocket. It requires continuous capital to maintain its existence. By this definition, a primary residence does not generate cash flow. You cannot live in an investment property and collect rent from yourself simultaneously. Therefore, the house you live in fails the primary test of an asset. But the argument is always, the house appreciates in value. Let us analyze the appreciation math. Assume you purchase a house in the United States for $500,000. Historically, real estate appreciates at an average of 3 to 4% per year. However, that appreciation is not profit. It is an illusion created by inflation. If the currency is devalued by 3% due to inflation, and your house appreciates by 3%, the real purchasing power of your house has not increased. You need a larger number of dollars to buy the exact same house a year later. You are not gaining wealth. You are merely storing devaluing currency in a highly illiquid structure. But the mathematical trap goes much deeper than inflation. It is found in the cost of capital. When you purchase a $500,000 home with a 20% down payment, you put down $100,000. You borrow $400,000 from a bank at a standard 30-year fixed mortgage. Let us assume a 7% interest rate. Over the lifespan of that 30-year mortgage, you will not pay back $400,000. You will pay the bank $558,000. In interest alone, you purchased a $500,000 asset and paid an additional $558,000 simply for the privilege of holding the title. If you sell the house after 30 years for $800,000, the narrative is that you made $300,000. The math shows you actually lost $258,000 in total capital, adjusted for the time value of money. The bank profited. You held the debt. Then comes the structural drain of property taxes and maintenance. In the United States, property tax is a perpetual rent you pay to the government for the right to live on land you theoretically own. If you live in a state with a 2% property tax rate on a $500,000 home, you owe $10,000 a year. Over 30 years, that is $300,000 extracted from your income. Add structural maintenance, roofs, HVAC systems, plumbing, landscaping. The standard metric is 1% of the home's value per year. That is another $5,000 a year. Over 30 years, another $150,000. Your $500,000 house did not cost you $500,000. It cost you over $1,500,000 in total capital outlay over 3 decades. Now, we must apply the most critical financial concept that homeowners ignore: opportunity cost. Opportunity cost is the potential gain you forfeit by choosing one financial path over another. Let us run the alternative mathematical model, the rent and invest model. Instead of putting $100,000 into a down payment, you invest that capital into a diversified portfolio of productive assets. Over long periods of time, diversified equity investments have historically generated positive long-term returns, although future returns are never guaranteed. Instead of paying a $3,000 monthly mortgage plus taxes plus maintenance, you rent a comparable property for $2,500 a month and invest the $500 difference into your diversified portfolio of productive assets every single month. Over 30 years, the combination of your initial $100,000 investment, together with consistent monthly $500 contributions, has the potential to grow substantially through the power of long-term compounding. The exact outcome will depend on market performance, but disciplined investing has historically rewarded patient investors over long periods of time. Unlike home equity, these investments are generally far more liquid. You do not have to sell a house or pay real estate commissions simply to access a portion of your money. That flexibility is one of the defining characteristics of a financial asset. So why is home ownership so often presented as the ultimate path to building wealth? Because for many families, a home serves multiple purposes at once. It provides shelter, stability, and the possibility of long-term appreciation. At the same time, it also creates long-term financial obligations that can influence future decisions. A homeowner with a 30-year mortgage may find it more difficult to relocate for a new opportunity. Selling a home takes time, involves transaction costs, and may not always align with changing career or personal circumstances. As a result, a significant portion of personal wealth can remain tied to a single property. Long-term financial commitments can also affect career decisions. People carrying large monthly mortgage obligations may naturally become more cautious about changing jobs, starting a business, or taking financial risks because maintaining a stable income becomes a higher priority. Mortgage lending also plays an important role in the broader financial system. Banks earn income by providing loans, while governments collect property taxes that help fund local services such as schools, roads, emergency services, and public infrastructure. This does not mean buying a house is inherently a bad financial decision. It simply means that a primary residence should be evaluated for what it actually is, a place to live that comes with both financial costs and potential long-term benefits. If you value stability, the freedom to customize your home, or protection from rising rents, home ownership may be the right lifestyle choice for you. Those are meaningful benefits that cannot always be measured on a spreadsheet. But lifestyle decisions and investment decisions are not always the same thing. A primary residence should not automatically be viewed as an investment simply because its market price may increase. The more important question is how it affects your overall cash flow, flexibility, and long-term financial goals. Long-term wealth is ultimately built by owning assets that have the potential to generate value over time while balancing risk, liquidity, and personal priorities. Where you choose to live and how you choose to invest are related decisions, but they are not necessarily the same decision. Understand the numbers.